Hi, Assalamualaikum. My name is Qatrunnada Nadhirah from DFI2 K1. My metric number is 01 DFI2 for F1009.
My name is Khatthalin anak perempuan Sokwi and my metric number is 01 DFI24F1010.
Hi, my name is Lekkha anak perempuan Rakesh. My metric number is 01 DFI24F1017.
Accounting is the systematic process of recording, summarizing and analyzing financial transactions to ensure business maintain accurate financial record. At the heart of this process are the book of account, which include journal, ledgers and others books. Having a proper accounting system is very important. The importance of accounting system is to help business know if they are making a profit, plans for the futures, and follow the legal rules. Without accounting, business could lose track of their finance and face serious problem. In this video, we will go through the basic step of accounting and the different types of book used to keep record of accounting.
Hi, today I would like to talk about accounting process, a fundamental system that ensures financial accuracy in any business. This process consists of several key steps, each playing an important role in recording and analyzing financial transactions. So let's get started. So this is the accounting process step by step. The first one, we got identifying transaction. Second, recording transaction or journalizing. Third, posting to ledger. 4, preparing trial balance. 5, adjusting entries. 6, preparing financial statement. 7, closing entries. 8, posting closing trial balance. 9 is optional. 8 was reversing entries. So here the cycle, accounting cycle. At here we have 10, analyzing transaction, preparing journal entries, post journal entries, prepare unadjusted trial balance. 5, make adjusting journal entries. 6, preparing adjusted trial balance. 7, preparing financial statement. 8, preparing closing entries. 9, preparing post-closing trial balance. And the last one, create and post reversing entries. And it was optional. So here I will talk about 9 steps. So the first one, or the first step, is identifying transaction in accounting. Not every event is recorded, only those with financial impact. These are included sales, expense, purchases and payment. For example, if a company buys new equipment, that's transaction because it affects the company financial position. For the second step is journalizing or recording transaction. Once transactions are identified, they are recorded in a journal. This step follows the double entry system, meaning every transaction has both a debit and a credit. For instance, if we purchase supply for 500 ringgit, we record a debit to supply and a credit to cash. This ensures that our book remain a balance. For the third step, posting to the ledger. After journalizing, we transfer entries to the ledger, which is a collection of accounts. Think of it as an organized record of all transactions. This step categories transaction into different accounts such as asset, liability, and revenues. For the next step, preparing trial balance. We prepare a trial balance to check if our total debits and credit are equal. This help us to detect error before moving forward. If the trial balance doesn't match, we must investigate and correct the mistake before the proceeding. This is an example adjusted trial balance. We must to get debit and credit side balanced and equal. For the next step, we make adjustment for expenses or revenue that have not been recorded yet. For example, if rent is paid in advance, we must allocate the expense correctly over the month. Adjusting entries ensure financial statement reflect the true financial position. For the preparing financial statement, when adjustments are made, we prepare the financial statement. The income statement show profit or loss. The balance sheet display asset, liability, and equity. The cash flow statement track cash movement. This report help business make informed decision. This is an example adjusting entries for step 5. For the step 7, closing entries, at the end of the period, we close temporary account like revenue and expenses. This reset them for the next accounting cycle and transfers net income to retained earning. For the next step, holding closing trial balance. After closing entries, we prepare another trial balance to confirm that only permanent account remain. This ensures our books are clean for the next period. The last step, which is optional, is reversing entries. The simplified recording certain future transaction in the next accounting period, making bookkeeping more efficient.
Books of accounts. Books of account are systematic record of financial transactions maintained by an individual, business, or organizations to ensure coherence in financial reporting and complements with accounting principle. Example: journal, cash book, subsidiaries book, and ledger. Journal. Journal is a sheet in which all business transactions entry are recorded in chronological order. Journal entry must be posted to the ledger of related account based on the double entry system. There are two types of journal. First is general journal. General journal is a basic journal used to record all business transactions that cannot be recorded in cash book, or special journal such as purchase, sales, cash receipt, and cash payment journal. General journal is used for sales or purchase of non-current asset on credit. Second is corrections of error. Third is opening entries. Fourth is transfer. Fifth is withdrawal of inventory for owner use. Sixth is adjustment. Second type of journal is special journal or subsidiary book. Special journal is used to record a specific type of transactions only. Example is purchase journal, sales journal, purchase return journal called as return outward journal, and sales return journal called as return inward journal. First is purchase journal. The purchase journal is a list of record of all credit purchases for each period. It's used for posting credit purchase to the purchase ledger. Second is sales journal. The sales journal is a list of record of all credit sales for each period. It's used for posting credit sale to the sales ledger. Next is sales return journal. The return invoice journal is used to record goods returned to us from customer. The reason customer returning goods to us, such as goods were the wrong type, goods were wrong color, goods were fault. The last one is purchase return journal. The return outward journal is used to record goods returned by us to our supplier. Cash book, an alternative to the cash receipt and cash of journal in the cash book. All money received is recorded in debit side of cash book. On the other hand, all money paid is recorded in credit side of the cash book. A ledger is the principal book for recording and totaling economic transactions measured in terms of monetary unit of account by account type with debit and credit in separate column and beginning monetary balance and ending monetary balance for each account. All ledger accounts must be balanced before a trial balance is prepared. All ledger account is balanced by comparing the total debit amount with the total credit amount and determine which amount is larger. First type of ledger is general ledger. A ledger for all other accounts that is other than accounts receivable and account payable personal account. It used for posting for total credit purchase, posting for total credit sales, posting for total return outward, posting for total return inward, posting for total payment made, and posting for total payment received. Second type of ledger is purchase or account payable ledger, a ledger for supplier personal accounts. It used for posting for credit purchase, posting for return outward, and posting for payment made. Last one is sales or account receivable ledger, a ledger for accounts receivable personal accounts. It used for posting for credit sale, posting for return inward, and posting for payment received. In addition, how they help in organizing and summarizing financial data. First is systematic recording that ensure all transactions are recorded in a structured manner. Second is categorizations. Transactions are grouped under different accounts for easy reference. Third is enquiries and double checking. The ledger and cash book allow verifications of journal entries. The last one is financial analysis. Data from this book help in preparing financial statements like the profit and loss account and balance sheet. Thank you.
In summary, the accounting process plays a vital role in ensuring financial accuracy, transparency, and compliance for business. By systematically recording transactions, posting them in ledger, and preparing financial statements, companies can maintain a clear picture of their financial positions. Book of accounts, such as journal and ledger, help organize and summarize financial data efficiently, making it easier for business to manage cash flow, track profitability, and plan for the future. Ultimately, a well-maintained accounting system ensures accurate and reliable financial reporting, which is crucial for decision-making, investor confidence, and business success.